In this video, we're going to be applying everything to our firm. We're going to be looking ahead just a little bit and calculating a bunch of inputs that we're going to need for our next homework assignment primarily. We are going to be looking at the target capital structure for our firm. The reason being those W's, which make up the target capital structure for our firm, are the same W's we will be needing to calculate a weighted average cost of capital. So with that introduction, let's jump ahead and say specifically what we're going to be doing in this particular assignment. So in this chapter, we're going to be applying what we know to a real company we've chosen for the semester. In particular, we're going to be estimating the target capital structure. And what I mean by not covered in the text, I mean the actual how do we estimate this is not really covered in the text specifically. But we're going to apply the concepts that we've already talked about and say, how would you do this if you had to come up with a number, because we're going to need that number for the weighted average cost of capital. And so we're going to do it even though the process really is not outlined in the textbook. So number 2, we're going to use the Hamada equation to estimate the cost of equity under different capital structures. And specifically, we'll look at it for now, and we'll look at it under a whole bunch of different outcomes, including unlevered. And there's a reason for that, and we'll show it to you next homework assignment. So hang in there. Those are the 2 things we're going to do. Seems fairly easy, fairly straightforward, and hopefully this won't take too long. So here we go. Number 1, estimating the target capital structure. So capital structure is measured in finance at market value, not at book value. Whenever possible, we're going to use actual market values and costs. Problem is, and by the way, when I say costs, I mean cost of capital. Whenever possible, we'll use that, but in the case of debt, it's almost never possible. So we're going to be using a lot of book value of debt, market value of equity. Most corporate debt's not publicly traded, and therefore we're not going to be able to look at the market value of most of the debt. And so we're going to be using book value, which is actually rather close to the market value anyway, because it's too often marked to market, so to speak. Whenever you put things on your books, you kind of put them in at the market value at the time. With equity, though, since it never really has a maturity, it can be way off. The book value of equity may be way off of its market value. However, debt, which gets replaced on a regular basis because you have to pay it off and then issue new debt, that's really a lot closer to its market value anyway. So we don't lose as much by going with the book value of debt. All debt should be used to arrive at our weight, and that's really what we're looking at for this target capital structure. We're looking at the proportion of debt, capital debt to capital equity. That's really what we're going to be spending most of our time looking at. That weight, when we look at the weight, we have to include all of the debt, including the stuff that doesn't show up on the balance sheet. The primary type of debt that doesn't show up on the balance sheet is operating leases. And we've already looked at those, so we're going to go back and grab that earlier homework assignment and pull those numbers because they become all of a sudden very, very, very relevant. The other problem that we're going to have, by the way, with estimating the target capital structure is that the actual capital structure is not static, meaning it moves up and down and up and down and up and down and up and down over time. And because of that, we're going to have to figure out where the target is. But the theory, at least, suggests that these companies are hovering around the target capital structure. They may go a little higher, a little lower, a little higher, a little lower. Remember, they usually don't go too much further above the optimal capital structure, but they can go above and below the target capital structure. And so we're going to make a few assumptions, and then if you want to, you can tweak this a little bit based on what you know or you don't know about this. Well, hopefully it's what you know or you have a strong gut feel with your particular company. I'm always intrigued by what it is you're seeing there, because sometimes you can get much better estimates if you go, well, here's what I'm seeing, and it's actually rather accurate. That's always helpful. So we'll compile a history of the firm's debt levels, both on and off balance sheet. We'll compile the level of equity invested in the firm using market values. And then over time, we're going to say, what does it seem like this is hovering around? Easiest way of doing that is looking at an average. With that introduction, let's actually go out and do some of this. And for this, I'm starting a new spreadsheet. So I started one. If you could see the top, it actually does say Book 1-Excel, which basically means it's brand new. This is a brand spanking new Excel spreadsheet. So we're going to be looking at some capital debt, and remember, this is only capital debt. So to begin with, we need to say year. We're going to be looking at the capital debt. Then we're going to be looking at the operating leases. And in fact, if I wanted to, in fact, this actually comes in two pieces. So let me do, with my company. With your company, it may just come in one, may come in five. I don't know. In my company, it actually comes in long-term debt. And then it has current maturity of long-term debt. That's what CMLTD stands for. And then we have our operating leases. And then what I need to look at, because that's the first chunk, that's all the debt. And in fact, what I could do, just to make this even more obvious, I'm going to move that down and then say, this is capital debt. And then just highlight all of that, move up here, merge and center, and then move next door and say, in addition to that, we want the market value of the equity. The market value of the equity is going to be number of shares outstanding. So I'm going to say number shares. And then what is the price per share? Price per share. These two are capital equity. And again, I'm going to merge and center. And just to be clear, I could say, let's put up some lines so we can see that this is the debt, this is the equity. In fact, let me draw down here. I don't know that I'm going to need this many, but we'll see how many I need once we get moving. And then based on that, we're going to do a W. Actually, no, then we'll do total capital. Let me draw a nice little line there. And then we'll say, actually, let me move that one down. Oh, that was weird. And then we're going to say WD and WS. And I do have to change the D so that it is subscripted, and change the S the same way. One other real quick formatting issue, I'm just going to do a line, probably a thick line, just to set it off, saying that these are the headings and down below isn't. And I think I'm going to change the font just because I don't necessarily like Calibri either. The problem is, by the time I'm finished with this, nothing will look like anything. So, well, we'll do Callisto. I haven't done that one for a while, so what the heck. Actually, let's then center that one. Okay. That one's not wide enough. There we go. All right, I want these in the same order all the way through. That's why I did it this way. So I think the way they're done, since they're going to come off of the balance sheet, etc., I'm going to do 2013, 2012. And again, these probably can be centered. Highlight those and move back to about 2007. I have that many in my financial statements, whereas you may not. So just do the number that you have on your financial statements, and yeah, I kind of went overboard. I know I could have done these all together, but what the heck. All right, having done that, in fact, let me make that one bold and that one bold. There we go. I don't know if that makes any difference, but what the heck. So I'm going to be looking at the balance sheet because their debt is not publicly traded. I can't go check on the bond markets and see what they're currently trading at and how much there are still outstanding. So what I'm going to be doing, and this table is just looking at the levels at this point. We're not going to be looking at the individual costs per se. We're going to look at those in weighted average cost of capital next homework assignment. So we're just looking at the levels. Okay. So having said that, let me pop over to the historical financial statements. All right, these are the historical financial statements, which appear to be just a smidgen off. There we go. And these are the balance sheets. I'm going to scroll. Well, I guess I don't have to scroll anywhere. So these go 2013 to 2007, and I'm just going to grab the pieces that I need. Now, what we should be looking for in this component are anything in the liabilities that came from the capital market. And remember, these have to first off come from a financial market, and second off come from the capital market. The capital market had an initial maturity of a year or more. So anything that's long-term debt would come from the capital market, even if it came from a bank. So all this stuff is fair game. So I'm going to copy it, and then I'm going to move over to my sheet that I've just created, and I'm going to paste special. I'm going to transpose and do values. Yeah, number of formats. I'm hoping that the font will stay the same. Yeah, font will stay the same, so we'll find out. I think it did. So this is the amount of debt that they had outstanding from 2013 all the way back to 2007. They had a whole bunch back in 2007 because they were just trying to dig themselves out of the debt hole that they had dug for themselves. This is the long-term portion of it. We're going to look at the current portion because it's really part of the long-term debt. It's just the stuff that happens to be getting paid this year. So I'm going to pop back over to my historical balance sheet and pick up the current maturity of long-term debt. I'm going to copy it. And we're going to do the same thing. We're going to paste special, values, number, formats, and transpose. And there it all is. It's so bizarre that these don't line up any better than they do. Just a sec. Copy and paste special, formats. And they're all, that should make them all line up, which is what I was going for. They still have all the commas in and they line up better. These are probably off as well, so maybe I'll also do those. Paste special, formats. And it should have made all of those line up better as well. So now we just have to do the operating leases. And for that, I'm going to go to the homework assignment that we did that included operating leases, which is part of our amortization. No, it was, I'm trying to remember. It was either the amortization schedule component or the time value of money. I'm not really sure. I think it was time value of money. So go back and take a look at that one. It looks like this somehow. And I'm going to be picking up these things down at the bottom, assets financed by operating leases, and I gathered as many as I had on my balance sheet. So I'm going to copy. And again, this is just picking stuff up from earlier homework assignments. And then I'm going to paste special again. We're going to do values, number formats, and I guess we don't need to transpose in this case. It already went up and down rather than side to side. So I'm going to hit OK. It dumps it all in there. Now these are odd. I'm going to actually back those off a little so that they're in the same, pretty much the same units. And so we can tell that during this, over this 2013 year, we have a total of $47 million being funded, and the year before $35 million, the year before $52 million, and so on, all the way back to the earliest one with $133 million. Ooh, that was bad. So let's look at the number of shares and then the price per share. And again, I've already collected this information because I did it when I did my ratio analysis. And I put it along the bottom of my balance sheet. So let's go back to the historical balance sheet. Scroll down. And I have the price of the stock and the number of shares outstanding. Oh, I wish I'd have done those the other way around. Oh well. Well, actually, let's do that. I'm moving the order really briefly because then I can look at them. I can bring them over together. So I'm going to grab all of those and go copy. And I'm going to then paste values and number formats and then transpose. I'm going to widen that one out a bit. Actually, you know what? I think I'm going to add an extra column here because I really needed to find out what the total was before I started doing weird things here. So let me first off adjust my lines. Second off, widen that out just a little bit more and put in here total equity. So I can see what my total equity capital is. This is what's called the market capitalization, by the way, at this moment. So equal number of shares times price per share. And I'm going to widen that out a bit and then take it down. So it's as high as it's ever been as far as the market cap is concerned. At the same time, the total amount of debt is probably not very high. And so maybe what I can do here is add one over here as well. Let me insert. And in this instance, do the same thing that I did before, which was taking off that one line and then saying total debt. And again, remerging, and then probably center that one, and then say equals sum. And we're going to sum those three. It's probably going to give me a nice little green thing up here, which means you forgot one. Yeah, I forgot the year on purpose, trust me. So I'm going to bring that one down. You can see, interestingly enough, this one has the highest number in the same place that that one had its lowest number. Kind of interesting. And so we're going to be looking at total capital being equal to total debt plus total equity. If you have preferred stock, you're going to have to do this one. We're going to have to expand it a little bit. If you have preferred stock, please email me because I'm going to be really shocked. And then I'll have to put something out there that says, oh, here's how you do it with preferred stock. But let me know if you do have some. So, and there is the total amount of capital. And now the WD for that time period, and this is not the target WD, this is just how much of the total is in debt. So I'm going to look at total debt divided by total capital. So we have 30%. Has been as high as almost 80%. Now we're going to do the same thing with the equity divided by total capital. Now, by the way, if we did this right, I should highlight both of those and look down here for the total, and should say sum of 1. The average should say 0.5 in every instance. So I'm going to move that all the way down. So I could have done it there. I should have 1 and 0.5. I could do it here. I'll get the same thing, 1 and 0.5. Okay, it's going to be the same no matter what. All right. The real kicker here, however, is this. I'm going to come down here and say, what is the target? What is the point around which we've been going up and down and up and down, up and down, around? Well, the easiest way of finding that is what's the midpoint that we've been going up, all around. So I'm going to say equal average, highlight them, hit enter. That one's 53. That one's 46. We're using a little bit more debt than equity. Now, note this may be very different from the way things are right now, but again, I could be at a low point on my debt scale here, and they may be looking for opportunities to increase their debt. You will notice that in the last couple of years they have been doing just that. Why? Well, again, go back. In fact, let me go back and summarize. One last comment on target capital structure. Once we have the target capital structure estimated, take a little time and explain which concepts have led your firm to that capital structure. Remember, I used all of those things to say how much business risk did we have. Include in your discussion the stuff about business risk. Are the sales volatile? Are the input prices volatile? Can we pass those changes in input prices onto our customers? And what proportion of our total operating expenses are actually fixed costs? All of those things said take on more debt. The tax rate was fairly substantial in my company, and therefore that was also saying you could get a bigger bang out of taking on more debt. This one was a little iffy. They really weren't in the equity market that much, so the equity market stuff was not in its favor, but they should take on a fair amount of debt so far. And then the only thing that was a huge proportion of, well, do they really want to take on more debt or not, was their managers may say, I don't think I want to, but they didn't hold a very huge portion of the firm, so the firm is probably going to be closer to its optimal rather than what the CEO would like to be the target capital structure. And based on that, the 50-50 that I nearly got there makes a lot of sense. So I could even say, if I wanted to tweak it, maybe 50-50-ish. I think I'm going to use the ones that I get out of here because it's based on something, but my guess is it's somewhere around 50-50. So that's the first one. I've now done my W's. I have my WD and my WS. And I feel pretty confident about those. Those are probably pretty close to what the target is for the firm. And it looks like they're now at a low point that they've been starting to add a little bit more debt. And they're not really that concerned about adding a little bit more debt. So that's okay. It makes some sense. What I'm seeing here is making sense. Make sure that yours is making as much sense, by the way. And now, let's look at the other half of this, which is what happens when we do add some debt or take some debt away. What happens to my required return to my stockholders? So this one's going to be interesting, by the way, because in the next homework assignment, I'm going to have you look at weighted average cost of capital as it stands. And then we're going to look at what would happen if they got rid of all their debt, because a lot of times people say, man, if this company would finally get rid of some of their debt, they'd be so much better off. We're going to test that hypothesis by saying, therefore, if they did get rid of it, how much would the firm be worth, the total firm be worth? And so we're going to be looking at those issues in the next homework assignment. And with this one, though, we want to see how to make those adjustments to our required rate of return to our stockholder. As it turns out, as the level of debt increases, the risk to the equity investor also increases. But as we've shown, and you can even see this in that DuPont analysis, as we looked at the DuPont analysis, the more leverage we take on, the higher the return on equity. And so we can get higher return, but we get it with higher risk. Well, that suggests that maybe the systematic risk is going to go up too as we take on more debt. And that should mean that the beta should change. And there was a researcher back in, I think it was the 60s, or I think it was actually the 1970s, who looked at the underlying theory of the capital asset pricing model and derived algebraically how to adjust the return, the required return to the equity investors based on different levels of debt. And so it's that set of relationships that we're going to be using to estimate the adjustments here. So Hamada derived one relationship in the paper, and essentially then once you derive the one, then you just use some algebra to solve for the other. Now I've adjusted the notation here to be just slightly different from in the book, because I wanted to point out that these B's that he has in the book, that they have in the book, are really the beta estimate. And the best way of doing that is actually making them betas, okay? So the beta without any letter below it is the beta with debt. And the B sub U would be the unlevered beta. And so this equation right here will tell you, if you knew what the beta was for the company if it had no debt, you could figure out what the beta of any level of debt is just by putting in the WD of how much debt they're having to how much equity. So in essence, that WD over WS is really just a debt to equity ratio. But it's a market debt to equity ratio, okay? And the 1 minus T is the tax rate. And we'll just use the same tax rate we've been using, at least in the operating leverage component, which was a 35% tax rate. Although honestly, the actual tax rate's around 33%. It's really, really, really close, and that's the average tax rate. So 35 to 40% would be the marginal tax rate. This T in this formula is really the marginal tax rate, which is going to be a little higher. It could be substantially higher, but it's going to be higher than the average tax rate, usually. So if we take that beta sub U, the unlevered beta, and here's where the trick comes in. So if no matter where we are right now, now that I know where the target is, now that I've hypothesized a target capital structure for my company, I can actually say, well, if that's the target and the market knows it, therefore I should be able to imply that unlevered beta just by putting the beta that I get for this company and then divide it by that whole mess, 1 plus 1 minus T times the debt to equity ratio, and I should get the unlevered beta. Once I get the unlevered beta, I can plug it into the top equation and get any beta for any debt to equity. And there's the beauty of this whole relationship, okay? And hopefully you can see that, and even if you can't, that's okay. I'm going to go do it for my company for lots and lots and lots and lots and lots and lots and lots of different levels of financial leverage. So here we go. I'm going to move back over to my Excel sheet, the one that was new, and here we are. Again, we have sheet 1, and I'm going to use this and call this my target capital structure. Wow, I need to spell correctly though. And then I'm going to hit this little plus sign next to it to give me another tab, because the other tab is where I'm going to be doing my Hamada stuff. Okay, so I'm going to click that. Then I'm going to double click my sheet 2 and say Hamada. Now before I get going too much on this, I need to say, come back over to my target capital structure and do my target debt equity ratio. Now my target debt to equity ratio is equal to debt to equity. That was easy. I'm going to go back over to At this point, I do need my observed beta. And so let me go find my observed beta. Okay, I've gone back to the sheet that I had where I valued my stock, because in so doing I had to bring over my beta estimate. Wow. My beta estimate, my risk premium, and RF, and all of this jazz that I needed. So I'm going to copy these and bring them over to the sheet that I'm currently working on. So I'm going to hit paste, and we're good to go, hopefully. So we have our R sub S right there, the 9.5%. So what I'm going to do first is I'm going to go over here to Hamada sheet, and I'm going to put in here different levels of debt equity. So I'm going to say debt to equity, and then I'm going to put right next to it the beta, and then right next to that I'm going to be putting the RS. I'm going to highlight my S and subscript. Now, the unlevered beta, by the way, is 0 debt to equity. That means unlevered, meaning no debt. So first off, let me go in here and I'm going to do the, oh wow, I was hoping I would have this, but I guess I don't, so never mind. So let me highlight those, underline them, and center, and center. There we go. So the unlevered beta, we're going to use the unlevered beta formula. So I'm going to take, in this instance, I'm going to take the actual beta that I've observed and put it in the numerator. I'm going to take the tax rate that I'm assuming of about 35%. I'm going to take the WD from the target, the WS from the target, because those target debt to equity should give me, or should yield, my original beta, and the tax rate of 35%. So that's what I'm going to be using as my inputs, just so you know where everything's coming from. We're going to be using this second equation. There we go. So for the DE of 0, that's the only place where we're unlevered, we're going to say is equal to the observed beta divided by parenthesis 1 plus parenthesis 1 minus 0.35, that's my tax rate, times debt to equity, which is actually that one right there, so I guess I didn't need the other parenthesis after all. And so I'm going to say enter. So if they would get rid of all of their debt, I would be estimating a beta of 0.63963. And therefore, what should I be expecting from a return to the stockholder, the required return on my stock? That's going to be equals the risk-free rate, risk-free, plus risk premium times the hypothesized, or unlevered beta in this case. And I am going to bring that down. I don't know why it does that. For some reason it likes to give me like way too much, way too many decimal points. Now at this next point I'm going to say 0.1. What would happen if my debt to equity ratio went up by 0.1? Now remember, this company has been as high as 120, 130%. That's 1.2, and I'm at 0.1 here. So, and again with this beta, what would beta be? Now we're relevering beta. with this being my hypothesized debt to equity ratio. We're going to be using this other formula, the beta without the u on it, equal to blah, 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 blah. In this case, we're going to do the unlevered beta. That's the stuff in times 0, so we're going to have to hit that F4 key for that one, times 1 plus 1 minus 0.35 times the hypothesized debt to equity ratio. Okay, just so you can see what we're doing. So I'm going next door. I'm going to say equals this number whoops, not that number. What a goof. That number always. So I'm going to hit F4 times parenthesis 1 plus parenthesis 1 minus 0.35 times the debt to equity. Now notice my formula has gone on top of it, but if I go up one and then use my down arrow key, yeah, I'm cheating. I love to cheat. So now put the closing parenthesis on. So again, to get that last one in there, you could actually type in A3, or what I did was I went up to A2 and used my down arrow key once, and it would bring me down on top of that one, and then I can hit enter, and it gives me a number. Now this should have gone up, which it did. I'm just saying it should have gone up. If it didn't, then you did something screwy. I'm going to just bring that one down one. You can see it's going up. I'm going to highlight both of those and take us down to maybe 2. Let's actually give those, a set of decimal points. There we go. And with this one I'm just going to double click, and on this one I'm going to double click. Okay, that one did not work. That's because I did not use my dollar signs appropriately. Okay, so let's go back and use my dollar signs appropriately. So I'm going to go back on top of the first one and click on the J19 right there. That's my J19 anyway. I don't know what yours says. So capital structure, blah, 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 and I'm going to hit F4. I'm going to put my cell pointer between the J and the 18 as well and hit F4. And then I'm going to hit enter. And then we're going to go back over it all over again. And then we're going to highlight these because they're being goofy. Actually, I'm going to widen it just a hair. No, I guess I'm not. And we're going to reduce the number of decimal points. I don't know why they all decided to go way out there on me. That's just too freaky. Now, one last thing that I always like to do to double check. I'm going to go back over to my target capital structure. I'm going to look at my actual DE. I'm going to it's 1.15-ish. So right before I get to 1.15-ish, I'm going to actually enter a row right here. I'm going to insert it because that's where 1.15 would be. I'm not going to type in 1.15. I'm actually going to go back over to my target DE and copy it. Come back over here and paste special. And I'm going to tell it I want the value. It says 1.15, but you'll notice up here it actually says 1.147 and a whole bunch of junk. Having done that, now all I have to do is highlight both of those, bring them down, and this 9.5 should be the same number I have here, which it is, and my beta 1.11661 should be the same thing that I have here, 1.11661, and they are. And you may say, but it has a 3 afterward. Well, yeah, but this one doesn't have that much precision. If we expand it just a hair, you'll notice that it is exactly the same. Okay, so this is showing me, and this is what should happen, I should see the cost of equity increase as I increase my debt. If you see it increase then go down and then increase and then go down, yeah, you probably don't have these dollar signs in where you should have dollar signs in. Okay, so this is really all that this is trying to tell me, that as my debt increases, my cost of equity will increase. But it doesn't just say, oh, well, it'll increase. It tells me specifically how much it will increase. The reason that's important to me is because then hopefully I can find my optimal capital structure. And there's a part of the textbook where they say, here's how you could approach trying to figure out what your capital structure is. We're going to be doing something kind of similar but not exact. And honestly, we can't, getting it extremely precise would take a little bit of time and effort, and some of you may want to do that, but I usually don't. So at this point, I'm asking you to talk a little bit about this, to talk about where your company's target capital structure is and why. And that's about it for this homework assignment. So I hope that makes some sense, and I will see you in the next chapter where we're going to talk more about weighted average cost of capital.